Most new Forex traders stare at a chart and see chaos. Professionals often see something else: a box, a boundary, a range. And sometimes that simple box tells a bigger story than a dozen flashy indicators. Think about it. Price doesn't spend every day racing upward or crashing downward. Most of the time, it moves back and forth between support and resistance, almost as if the market is quietly negotiating with itself. That's where range calculation becomes powerful. Imagine a currency pair reaches a high of 1.1050 and a low of 1.1000 during a trading session. The range is just 50 pips. Simple math. But that number reveals something important. A 50-pip range suggests relatively calm conditions. A 200-pip range? That's a completely different market, filled with stronger momentum, bigger opportunities, and much higher risk. This is where many traders get trapped. They focus on predicting direction while ignoring distance. But distance determines position size, stop-loss placement, and realistic profit targets. Entering a trade with a 20-pip stop in a market that's regularly swinging 150 pips is like trying to stand still during a hurricane. The irony is that range doesn't